Good morning, and thanks for tuning in to February's topic discussion. I'm Nick Stern with Robert L. Stern Financial Services. I'm a certified financial planner here, and I hope you all are enjoying the very mild winter. I know I am, looking forward to golf season. Um, but jumping right into February's topic discussion, I wanted to give a refresher on some ways to get some last minute tax deductions and some considerations for you going forward and beyond into 2016. So, a very nice way to get a last minute tax deduction, even though it's 2016, this would be for 2015, provided that you have not filed your taxes yet, is if you have the money and it makes sense, you might be able to open up an individual retirement account. This would be pre-tax, so you get an immediate tax deduction for the amount that you're putting in. The limit if you're under 50 is $5,500. The limit if you're over 50 is $6,500. If you can't do that, you can do somewhere in between, but again, you get an immediate tax deduction. That money would then grow tax deferred, and you would get taxed when you take it out at age 59 and a half or beyond. That is the age when you begin to be able to make distributions without being penalized. Another consideration for you is when you are meeting with your accountant, tax preparer, doing it online yourself, what have you, just make sure that you're taking advantage of all the tax deductions and ways to save that are available to you, of course, within the IRS guidelines. Another thing to consider that I wanted to bring up, because it's tax time and because you might be getting a tax refund, is if you haven't opened either a long-term savings account or you haven't opened an individual retirement account, you might want to consider doing so, provided if it makes sense for your overall financial picture. If you are under certain income limitations, what you can do is you can actually open up either the pre-tax, what we talked about, and there's no income limitations there. But for a Roth, if you are making under 130,000 or so as a single, or 190,000 or so as married filing jointly, you are eligible for a Roth IRA. It works similar in that it's for retirement, and you want to designate any money going in there for age 59 and a half or beyond before you make any distributions. But the difference is that there's no immediate tax advantage. However, the money then grows tax-free, taken out tax-free. If you take it before age 59 and a half, you can incur a penalty depending on what the distribution is for. The reason why I bring this up is presumably over time you will at some point not be eligible for making contributions to a Roth, and even if you have a pre-tax retirement plan at work, this might be a really great way to diversify your retirement savings. Meaning if you have a majority of it at work in a pre-retirement or pre-tax account, this could be a way to do it so that not all the money that you have in retirement is taxable. I also want to bring this up because many of you might be getting tax refunds, and maybe this is a year that you'd like to become more financially organized. We have a video about that. Or you want to start saving for more longer term goals. If you haven't come up with longer term goals, I would urge you to begin, even if it's 10 or 15 minutes in an informal manner. Think about where you'd like to be financially, or whether or not there is a bigger picture goal that's not 1 or 2 years away, but 10 or 15 years away. That's really what I wanted to talk about today, and hopefully it's been of some value to you, as well as been either some new things that you didn't know, or just a refresher, things to consider while you're doing your taxes and regarding your overall financial picture and goals. Really appreciate you tuning in. There's a number, contact information, email on the bottom of the screen. There's no obligation. I'm here to help. Thanks for tuning in, and I will see you in March.